In this example, we are looking at how to calculate a trend analysis. So it says to use 2010 as the base year and prepare a trend analysis of the data that follows and tell whether the situation shown by the trends is favorable or unfavorable. So a trend analysis basically allows us to analyze what's happening over a period of time, and it's usually 3 years or longer. We're not comparing just 2 years, but at least 3 years that we're comparing in order to see a trend in what's happening to things over a period of time. And this just happens to be, we're going to be looking at what happens to net sales, cost of goods sold, general and administrative expenses, and operating income over a 5-year period. So the fact that we're using 2010 as a base year is very important because we're comparing everything to that year. We're seeing what is happening to everything compared to 2010. So the first thing we're going to do is we're going to look at our net sales. And you can see here that I have shown you the percentages and I've shown you the trend. But let's talk about where that came from. So everything basically is going to be divided by the 2010 amount. So 2010, since it's our base year, is always going to show 100%. And then in 2011, we take the 2011 net sales divided by 2010, and we have 104%. So what that means is our net sales have increased by 4% from 2010 to 2011. 2012, they've increased again. And here you can see the trend. So where it's increased 10% all the way from 2010, there's only been a 6% from 2011 to 2012. So at this point, if we would graph this, our line graph would start to slightly go up. But then in 2013, it came down a little bit. Our net sales in 2013 are a little bit less than our net sales for 2012. Granted, we're still 9% above where we started in 2010. We just came down a little bit from 2012 to 2013. And then we had a significant increase in 2014 in our net sales. But over a period of time, you can see what's happening to our net sales, and you can kind of imagine the graph line if we were to show a pretty constant increase. So then we're going to do the same thing for cost of goods sold. So cost of goods sold, everything's divided by 2010. So if you divide each of these numbers up here divided by 2010, you can see what's happening along the way. 2013, again, we went down a little bit in our cost of goods sold, which is a good thing. Since our net sales went down, you would expect the cost of those goods that we sold to go down as well. Then our general and administrative expenses, we can see what's happening to them over time in comparison to 2010. We take all the amounts shown in red here, how we calculated those amounts. And so our general and administrative expenses are slightly going up every year also. So it's not always a great thing to have our expenses go up, but then again, you have to spend money to make money. So if we're selling more items, we're producing more items, it does make sense for our expenses to go up, hopefully at the same rate and not at a greater rate. But then we look at our operating income and what's happening to our operating income. It's going up, and then all of a sudden in 2013 it went down, probably because in 2013 our net sales went up and our cost of goods sold, or our net sales went down, our cost of goods sold went down, but our general administrative expenses still were going up. So these were moving in the opposite directions, which caused a significant decrease in our net income from 2012 to 2013. And then in 2014, our actual net operating income is actually lower. It's gone down. It's less than what it was in 2010. So as this says, although our sales increased over the 5-year period, our operating income decreased because our cost of goods sold increased faster than our sales. So the cost of our goods sold, you can see from 2013 to 2014 had a significant jump. It increased by 13%, where we only had a 7% increase in our net sales. So that would be worth examining from a company standpoint to see why we had such a large jump there.